Hello everyone, and welcome to MBA 605 Auditing. I'm Professor Terry Camden, and I'll be guiding our auditing audio session today. Today we want to talk about reporting. Audit reporting is one of the key deliverables of the audit process. We talk a lot about planning the audit, determining whether to accept the client as the engagement, performing the audit steps, evaluating the audit evidence, and then reaching a decision. But the outcome of all of that is ultimately the audit report. So it's very important to understand what parts there are to the audit report, why it is important, what are the different types of audit reports that can come from the auditing exercise. So tonight we're going to talk about the parts of the standard unqualified audit report. We're going to specify conditions required to issue an unqualified audit report. We're going to understand reporting on financial statements and internal control under the Public Company Accounting Oversight Board auditing standards. We're going to describe 5 circumstances when we will use something slightly different than an unqualified audit report. We're also going to explain how materiality affects audit reporting. We'll talk about the other types of audit reports that cannot be issued or that can be issued when an unqualified opinion is not justified. And we'll determine the appropriate audit report under given audit situation. So parts of the standard unqualified audit report, and this is the report that we would issue when we come in, we perform our audit, we collect the evidence, we evaluate the evidence according to the criteria that we specify, and we determine that the financial statements are indeed fairly presented in accordance with generally accepted accounting principles. And once we've gotten to that point, then we can issue this standard unqualified audit report. And it includes a report title, the audit report address, the introductory paragraph, management's responsibility, the auditor's responsibility, an opinion paragraph, the name and address of the CPA firm, and the audit report date. And these parts are all important, and they're all fairly standard, and they're standard for a reason. It's not simply because we are not creative and we don't want to do something different each time. We want to use the same consistent language across audit reports so that the users of these reports know what that language means. And so what's it mean with respect to the liability of the auditor, and what's it mean from the respect of the user of the financial statements, and what their responsibilities are as far as understanding the financial statement. This provides us with a picture of an unqualified audit report, and we can see that the report title is the independent auditor's report. The report addressee is to the stockholders of the corporation. There's an introductory paragraph. We talk about management's responsibility, and that is that management is responsible for the preparation and fair presentation of financial statements in accordance with generally accepted accounting principles, not the auditor. We talk about the auditor's responsibility. We then go down to the scope paragraph that really talks about, well, what was the scope of our audit, and so what are we attesting to in these financial statements. We then go down to the audit opinion. Then we go to the name and address of the CPA firm and the audit report date. And it's important to note here that the audit report date is the date audit field work is completed. It's not the actual date it leaves the hands of the CPA firm. It's the date when audit field work is completed. And that becomes important later on with respect to subsequent liabilities and auditor liability. So the conditions for when we can use a standard unqualified audit report is when the audit report addresses all financial statements, when we've gathered, collected, and reviewed sufficient appropriate evidence, when the financial statements are presented in accordance with generally accepted accounting principles, and when no circumstances have surfaced as a result of our review requiring an explanatory paragraph or report modification. There are 4 categories of audit reports. One is the standard unqualified, and that's the 4 conditions stated earlier have been met. The other is an unqualified with emphasis of matter, explanatory wording, or modified wording. And we use this report when the financial statements are presented fairly, but the auditor believes it is important or is required to provide additional information. And this additional information is aimed at the users of the financial statement to help them understand something unique or special that surfaced as a result of the audit. We use a qualified audit report when the overall financial statements are presented fairly, but the scope of the audit has been materially restricted or applicable accounting standards were not followed in preparing the financial statements. And the qualified audit report says we came, we looked, the financial statements are presented fairly except for, and then we go into what these except for circumstances are. And then we can also issue an adverse or a disclaimer, and that's where the auditor concludes that the financial statements are not presented fairly, and that he or she is unable to form an opinion as to whether the financial statements are presented fairly, or if the auditor is not independent, which really is the disclaimer, where the auditor is not deemed to be independent, and so we can't say that the financial statements are presented unfairly, but we can't say that they're presented fairly, so we're disclaiming an opinion on it. So we also, as auditors, must, for publicly traded companies, subject to Section 404 of the Sarbanes-Oxley Act, must report on the effectiveness of internal control over financial reporting. And so with regard to this, we've come in and we've looked at the internal controls of the company, and we're also making some determination about whether those internal controls are operating effectively. So we can do this by issuing a separate internal control report, which we then have to reference when So the separate report in financial statements and internal control over financial reporting includes an introductory paragraph, the scope paragraph, a definition paragraph, inherent limitations paragraph, an opinion paragraph, and this cross-reference paragraph that gives the information on the accompanying audit report, which is a separate report. So essentially, when we're auditing public companies that are subject to Sarbanes-Oxley Section 404, we're conducting two audits, one over the financial statements and one over the internal controls surrounding financial reporting. We have to issue an audit opinion on both of those efforts. Those audit opinions can be combined in one report or separated in two reports. If they're separated in two reports, each report must cross-reference to the other. This is an example of a separate report on internal controls around financial reporting. And we can see we have an introductory paragraph that talks about the organization that's internal controls over financial reporting were audited. We talk about the standards that were applied to guide the audit, and those are generally the Treadway Commission standards. We move to a scope paragraph that talks about, well, what did we look at as far as internal controls? What was the scope of what our review covered? We have a definition paragraph. We have an inherent limitations paragraph. Then we provide an opinion paragraph, and this is the cross-reference paragraph that we spoke about earlier. So the 5 circumstances when an unqualified report with an emphasis of matter, explanatory paragraph, or modified wording is appropriate. And again, this is where we've come and we've looked and we've seen that, well, the financial statements are presented fairly, but there are some issues that we need to call to the attention of the users. And these issues would include a lack of consistent application of generally accepted accounting principles, substantial doubt about a going concern. That is, do we think that this business is not going to be able to stay in business for the next 12 months? When auditor agrees with a departure from the accounting principles, an emphasis of matter, or reports involving other auditors. So when we talk about this lack of consistent application of GAAP, auditors must note the circumstances in which accounting principles are not consistently applied. Auditors should modify the report when a material change occurs by adding an explanatory paragraph in the report. And what we'll do in this paragraph is also speak to the magnitude of this lack of consistent application of accounting principles. This substantial doubt about a going concern. Well, if there are significant recurring operating losses that result in working capital deficiencies, where we see the inability of the company to pay its obligations as they come due, where we may see a loss of major customers or the occurrence of some uninsured catastrophe, or where there may be legal proceedings or legislation that might jeopardize the entity's ability to operate. These are all situations that an auditor may look at and raise serious doubt with respect to that auditor's judgment about whether this company is going to be in business over the next 12 months. And if that's the case, the auditor is obligated to use this modified report to state this going concern doubt. Where an auditor agrees with a departure from a principle, the departure may not require a qualified or adverse opinion. And so if the auditor agrees that the client didn't follow GAAP, it may not be a significant enough departure that the financial statements aren't presented fairly so that an unqualified opinion can be used, but with some modified wording. The auditor must separately explain in the audit report that adhering to the principle would have produced a misleading result and that circumstances are unusual. When we talk about an emphasis of matter, again, these are all unqualified opinions that have some modified wording, explanatory paragraph, or emphasis of matter. And where an emphasis of matter happens is where the CPA may want to emphasize specific matters regarding the financial statement, even though the financial statements are fairly presented and an unqualified opinion is appropriate. And examples of these specific or certain instances would be financial statement comparability or subsequent events, related party transactions that may have influenced operating results, or material uncertainties. Reports involving other auditors are another example of when an auditor may use a explanatory or modified wording. Then they may the options with respect to where other auditors are involved are that they may make no reference in the audit report. That is, the current auditor is assuming liability for the predecessor or other auditor's work. They may make reference in the report, or they may qualify their opinion. And here's an example of a report that's involving other auditors. And as you can see, the scope paragraph is the same. And the opinion paragraph says, in our opinion, based on our audit and the report of other auditors, the financial statements referred to above present fairly in all material respects the financial position. So then when we talk about departures from an unqualified opinion, that is, when would we not be able to issue an unqualified opinion stating that the financial statements are presented fairly and in accordance with GAAP, regardless of whether we have some modified wording or explanatory paragraph for this matter of emphasis. And these situations which would call for departures would be examples such as a scope limitation, that is, were we not allowed access to some key piece of information and we couldn't mitigate that scope access, a departure from generally accepted accounting principles, or where the auditor may not be independent. In those cases, a qualified opinion report can result from the limitation on the scope of the audit or a failure to follow generally accepted accounting principles. And here's an example of a qualified opinion. And as you can see, the opinion paragraph, or we have a basis of qualified opinion. And so here in this basis of qualified opinion, the auditor is providing the background that led them to issue this qualified opinion. And then in the qualified opinion paragraph, the auditor references the basis for why they aren't able to issue an unqualified opinion. An adverse opinion is when, quite as it sounds, it's when the auditor believes the financial statements are not presented fairly in conformity with GAAP. So here's an example of an adverse opinion. And again, we have the basis for an adverse opinion, and we saw this basis paragraph being used for the qualified opinion previously. And then we have the adverse opinion that says, in our opinion, because of the significance of the matter described in the basis for adverse opinion paragraph, the financial statements referred to above do not present fairly the financial results of the company or the results of its operations and its cash flows for the year then ended. And this is a bad thing. For most companies, this is a very bad situation to be in, because essentially it says your financial statements cannot be relied on. Then we can also issue a disclaimer of an opinion. And what the disclaimer says, it is exactly that. It doesn't say that the financial statements are right or wrong. It simply says we're unable to make a decision and issue an opinion as to the correctness. And that's generally happens when the auditor cannot either has scope limitation that would not allow them to say that the results are fairly presented, or this lack of independence. And here's where we have a disclaimer of opinion. So again, we see this basis for disclaimer of opinion paragraph, right? That sets the stage for what our opinion is going to be. And then we have this disclaimer of opinion that says, because of the significance of the matter described in the basis for disclaimer of opinion paragraph, we have not been able to obtain sufficient appropriate evidence to provide a basis for an audit opinion. This is a very important sentence that follows. Accordingly, we do not express an opinion on these financial statements. And so it's very clear to the users of these financial statements when they look at this audit report that no opinion is expressed. And the users of these financial statements would know that when they're looking at this opinion paragraph that the financial statements aren't being told that the financial statements are wrong or not fairly presented. It's just that it cannot be determined that they're fairly or unfairly presented. So then we talk about materiality and how it affects audit reporting decisions. And this is important because a misstatement in the financial statements can be considered material if knowledge of the misstatement would affect a decision of a reasonable user of the statements. And so what that's saying is that it's material if the knowledge of the incident would be enough that the user of the financial statements might change their economic decision based on the difference. So levels of materiality. So one, of course, the first level is that they're immaterial. There's an error, there's a misstatement, but they're not material. Secondly, the amounts are material, but they do not overshadow the financial statements as a whole. So in the audit opinion, you know, what we're not auditing one statement or two statements. We're auditing all the financial statements, and the audit opinion speaks to the financial statements taken as a whole. So as long as the materiality doesn't overshadow or invalidate all the financial statements taken as a whole, it would not be a material enough financial statement to result in a qualified opinion. And then the next step is that the amounts are so material or so pervasive that overall fairness of the statements is in question. And obviously, when that's the case, we have the grounds for a qualified opinion. Materiality decisions include failure to follow GAAP, which are reported in the audit, or which impact the audit report, and which may then result in an unqualified, if they're not material, a qualified opinion only, or an adverse opinion. So then we see this table that speaks to the relationship of materiality to the type of opinion. So if we have a immaterial level of misstatement, the user's decisions are unlikely to be affected. It's a misstatement, it's wrong, we're willing to accept some level of wrongness in the financial statements, and it really isn't going to change the outcome of our economic decision. And there we would see an unqualified opinion. If it is material where the user's decisions are likely to be affected, we'll issue a qualified opinion. And if they are highly material where the user's decisions are likely to be significantly affected, we'll issue a disclaimer or an adverse opinion. And where it's highly material, if we issue an adverse opinion, we really are saying that you can't rely on these financial statements. So materiality decisions around non-GAAP conditions include dollar amounts compared with the base, measurability, and the nature of the item. Materiality decisions on scope limitations and how they affect the audit report can again issue an unqualified, a qualified scope and opinion, or a disclaimer. So we have each of these types of audit reports that could come out of a scope limitation issue depending on the materiality of the scope limitation. Modified audit reports are appropriate under a variety of circumstances, including the auditor's scope has been restricted, statements are not in conformity with GAAP, and the auditor is not independent. So here, the auditor's decision process. We need to determine whether any condition exists requiring a departure from a standard unqualified report. We have to first decide the materiality. Based on the materiality, we have to decide the appropriate type of report. That is it unqualified, is it qualified, or is it adverse? And then we have to write the audit report. So more than one condition requiring a departure or modification include items such as the auditor is not independent, there's a scope limitation, a going concern, uncertainty exists, and the statements are not prepared in accordance with GAAP. So any of these items, may require a departure from a unqualified report or even a modification. For instance, if the auditor is not independent, we would issue a disclaimer. So we're not issuing an unqualified, we're not issuing a qualified, we're issuing a disclaimer because we're not independent, so we can't say that they're fairly presented or unfairly presented. A going concern uncertainty exists. So there again, we're issuing a different kind of report. It's not unqualified, it's not qualified, and it's not an adverse opinion. So then we talk about this proposed use of internal accounting and auditing standards by U.S. companies, and we see this is an ongoing effort to incorporate the international financial reporting standards in the U.S. As a substitute for U.S. generally accepted accounting principles. And this is a very complicated process because of all the differences in the international communities with regard to financial reporting in the U.S. But it's a pressing problem as we see that globalization and continued globalization is occurring. And so currently we see a 2015 target date of implementation of the IFRs, or International Financial Reporting Standards, in the U.S. I suspect, given all the issues that are surrounding this, the complexity of the issues, and the problems that have surfaced at this point in time, that even this 2015 date will change. And so that's it for audit reports. I hope this audio was helpful in understanding it. Please make sure to read the text. Please make sure to review the slides again at the beginning of the learning objective, and then please move on to the discussion forums and learning exercises. Thank you.